Friends, thank you for being here today. What if I told you that the single greatest engine of modern economic growth, a $25 trillion phenomenon that has single-handedly propped up the street, our market, consumer spending, gross domestic product, is built not on infinite potential, but on a foundation of circular financing and unsustainable debt that is rapidly beginning to crumble? And what if the warning signs aren't coming from skeptics or naysayers on the fringe, but from the balance sheets of the very corporations that built this digital Tower of Babel? We stand at a precarious juncture in financial history. For the past several years, the global economy, and specifically the United States economy, has been entranced by a singular narrative, the promise of artificial intelligence. It was sold as the fourth industrial revolution, a technological leap so profound that it rendered traditional metrics of valuation and profitability obsolete. We were told to buy first and ask questions later. We were told that the capital expenditures, the hundreds of billions of dollars poured into data centers, DPS, and energy infrastructure were merely the table stakes for a utopian future of limitless productivity, time and wealth. But as we move toward the close of 2025, the mood music has changed. The questions we were told not to ask are now the only ones that matter. The narrative of infinite growth is colliding violently with the reality of negative cash flows, tightening credit markets, and a labor market that is shrinking, not expanding. Under the weight of automation, this analysis serves as a comprehensive dissection of the current state of the AI bubble. We will not deal in hyperbole or speculation, but in the hard data provided by earnings reports, executive guidance, and macroeconomic signals. We will trace the cracks forming in the corporate giants, from IBM to Oracle. We will expose the structural fragility of a market dependent on a handful of hyperscalers. We will analyze the terrifying dependence of the U.S. consumer economy on inflated asset prices. And finally, we will map the great rotation of capital that has already begun, as smart money flees the scene of the speculation for the safety of tangible assets. To understand the full gravity of why this bubble is bursting, we must first confront the corporate awakening and the growing conundrum surrounding capital expenditures. For years, the message from Silicon Valley to Wall Street was uniform: spend whatever it takes. But earlier this month, a crack appeared in the facade that was impossible to ignore. The CEO of IBM, a legacy tech giant with a vantage point over the entire sector, stated on the record that there is no way that all this massive spending on AI and data centers will ever be able to pay off. This was not a minor adjustment in guidance. It was an existential indictment of the current investment cycle. This sentiment is not occurring in a vacuum. It is being corroborated by the shocking financial results of the industry stalwarts. Consider the case of Oracle. For decades, Oracle has been a cash-generating machine, a blue-chip stock known for its stability and massive free cash flow. Yet, in a stunning reversal, Oracle's free cash flow has turned negative. The company is burning cash at a rate unseen in its history. Why? Because it is caught in the Capex Conundrum. To remain relevant in the AI arms race, Oracle has been forced to issue what the market calls jumbo bonds, taking on massive amounts of debt to fund the purchase of chips and the construction of data centers. The CEO of Oracle attempted to reassure the markets by stating they were committed to maintaining their investment-grade credit rating. However, to a seasoned financial observer, this reassurance had the opposite effect. It confirmed that the rating is at risk. It confirmed that the company is borrowing from the future to fund a present that is not generating sufficient return. When a company that used to print money is forced to borrow just to keep the lights on in the server room, the dynamics of the market have fundamentally shifted. Similarly, we witnessed a critical misstep from Broadcom, another titan of the semiconductor industry. Broadcom reported backlog numbers that initially dazzled the market, billions of dollars in orders. Line up, but when pressed, the CEO clarified that these were minimum figures, a statement intended to project confidence but which instead shattered trust. The market realized that if the backlog is soft, or if it is based on double ordering from panicked customers, the future revenue streams are far less secure than the valuation implies. At the center of this storm sits Nvidia. Nvidia is the poster child of the AI bubble, the first company to reach a $5 trillion valuation, surpassing the GDP of major nations. Its stock is up 500% in 5 years, but the law of large numbers is undefeated. You cannot grow at triple-digit percentages forever. We are already seeing the deceleration. Revenue growth has slowed from a staggering 262% year-over-year in 2020 for 256% recently. While 56% is objectively impressive, it is fatal for a stock priced for perfection. The market does not price stocks based on past glory. It prices them on future acceleration, if Nvidia's growth is merely good rather than astronomical. The mathematical justification for its stock price evaporates. This leads us to the heart of the corporate awakening, the return on investment ROI gap. A recent study out of Meta illuminated a devastating statistic: 95% of generative AI pilots at companies are FI. Corporations are spending billions to integrate these tools, hoping for a magic productivity boost. But they are finding that the technology is difficult to implement. Hallucinations are a liability, and the cost of running the queries often exceeds the value of the answers. The Capex Conundrum is simple. You cannot spend trillions of dollars on infrastructure to generate billions of pennies in revenue. The math does not work, and for the first time in this cycle, Wall Street is doing the math. I am curious to hear your perspective on this pivotal moment. Do you think these massive investments will eventually yield the returns Silicon Valley promises, or is the math truly broken? Please share your thoughts in the comments section below. If the slowing growth of individual companies is the symptom, we must now turn our attention to the structural fragility of the hyperscalers, which is the disease itself. The AI market is not a broad, decentralized ecosystem of thousands of thriving buyers. It is an oligopoly of terrifying concentration. When we analyze Nvidia's order book, we find that roughly 70% to 80% of its revenue comes from a tiny cohort of companies known as the Hyperscalers: Meta, Facebook, Amazon, Google, Alphabet, Microsoft, OpenAI, and Oracle. These 5 or 6 companies are essentially the entire market. They're engaged in a prisoner's dilemma. None of them can stop spending for fear of falling behind the others. Even if the spending makes no immediate economic sense, this creates a circular fragility. Nvidia's revenue is essentially the capital expenditure of these 5 companies. If just one of them blinks, if Mark Zuckerberg or Andy Jassy wakes up one morning and decides that the shareholders will no longer tolerate an $80 billion annual spend on data centers, the demand for chips collapses instantly. This is not a theoretical risk. It is already happening. Let us examine the recent earnings debacle at Meta. Meta reported a quarter that, by traditional standards, was spectacular. Revenue grew by 26% year-over-year. They crushed their top-line numbers, yet the stock plummeted by over 10% in the immediate aftermath. Why? Because investors looked at the expense line. Meta spent approximately $19 billion in a single quarter on AI capital expenditures. The market punished them not for failing to earn, but for spending too recklessly. This is a watershed moment. For 3 years, the market said, spend whatever you need to win. Now, the market is saying, stop burning our money on GPUs that aren't generating profit. If this sentiment spreads, if Amazon And Microsoft are also punished for their spending. They will be forced to cut back if they cut back. Nvidia's revenue drops. If Nvidia's revenue drops, the entire AI narrative unravels. It is a house of cards where the floor is supported by the ceiling. Furthermore, there is a physical constraint that is often overlooked in the digital hype: energy. The build-out of these data centers is colliding with the reality of the electrical grid in regions like Baltimore, Columbus, and Buffalo, areas heavily saturated with new data centers. Wholesale electricity prices have risen by roughly 270% over the last 5 years. This is not just a corporate line item. This is a political and social time bomb. When the price of electricity for families doubles because a local data center is training a large language model to write haikus, regulatory backlash is inevitable. We're approaching an energy cap. The grid cannot sustain the exponential growth of AI power consumption without massive, slow-moving infrastructure upgrades that will take decades, not quarters, to complete. Beyond the corporate structure, we must broaden our view to the macroeconomic pillar and the terrifying reality of the wealth effect. To view the AI bubble as merely a sector-specific issue is to misunderstand the precarious state of the American economy in 2025. AI is not just a sector. It has become the final load-bearing pillar of the entire US GDP. According to data compiled by Apollo Global Management and Harvard economists, the distortion is profound. Approximately 1/3 of all GDP growth in the United States in the first quarter of 2025 came from the construction of data centers and the sale of semiconductors. If you were to strip out the AI-related build-out, the US economy would not be growing at 3%. It would be growing at a sclerotic 0.1%. We are effectively in a forgot-how-to-grow economy that is masking its stagnation with a wartime infrastructure boom. But the danger goes deeper than GDP statistics. It lies in the wealth effect. The US economy is famously driven by consumer spending, which accounts for roughly 70% of economic activity. But who is the consumer? In 2025, the consumer is not the average worker. The bottom 80% of income earners have seen their discretionary spending flattened by inflation. They are spending only on necessities. Their consumption has barely kept pace with inflation since the pandemic. The engine of consumption is the top 10% to 20% of income earners. This cohort now drives nearly 50% of all consumer spending. And why are they spending? Because they feel rich. And why do they feel rich? Because they own assets. They own the S&P 500. They own the Nasdaq. And they own Nvidia. The explosion in AI stock valuations has created trillions of dollars in paper wealth for the baby boomer generation and the upper middle class. As long as their 401ks and brokerage accounts are hitting all-time highs, they will continue to buy cars, go on vacations, and renovate homes. This is the terrifying leverage inherent in the system. The stock market is not reflecting the economy. The stock market is the economy. If the AI bubble bursts, if the Nasdaq corrects by 30% or 40%, which is historically consistent with the popping of a bubble of this magnitude, the wealth effect reverses instantly. The top 10% will snap their wallets shut. Since the bottom 90% are already tapped out, there is no backstop. Consumption will collapse, and the recession that follows will be deep and painful. We have seen this movie before. The parallels to the year 2000 are chilling today. The cyclically adjusted price-to-earnings CAPE ratio of the S&P 500 sits at 40. There is only one other time in history it has been this high, the peak of the dot-com bubble. Back then, the hero stock was Cisco Systems. Cisco was the picks and shovels trade of the internet. The company that made the routers and switches that made the web possible. The internet was real. It changed the world. But Cisco stock crashed 75% and never recovered its previous highs. Why? Because valuation matters. Because eventually, investors realized that even a revolutionary technology does not justify infinite price-to-earnings multiples. Nvidia is the Cisco of 2025. It is a great company selling a necessary product, priced as if the laws of economics no longer apply. While the financial metrics are alarming, we cannot ignore the human cost and what economists are calling the productivity paradox. There's a cruel irony at the heart of the AI narrative. We are told that AI will unleash a golden age of productivity that will lift all boats. Yet, if we look at the labor market data, AI is acting as a powerful deflationary force on wages and employment. In previous technological revolutions, new industries created more jobs than they destroyed. The automobile created mechanics, road builders and truck drivers. The internet created web designers, e-commerce logistics, and digital marketers. AI, by contrast, is designed specifically to replace high-cost cognitive labor. We are seeing a divergence between corporate revenue and corporate hiring that is unprecedented. Amazon, despite posting record cloud growth and surging revenues, recently announced the elimination of 14,000 management roles. UPS has cut 48,000 management and operations jobs. These are not struggling companies. These are profitable behemoths using AI to trim the fat. The most damning statistic comes from the software development sector itself, the very people building this future. According to data from Indeed, job openings for software developers have plummeted by 70% over the last 3 years. This is a catastrophe for the white-collar workforce. We were told that learning to code was the golden ticket to the middle class. Now, entry-level coding is being done by algorithms. Furthermore, the productivity boom is showing signs of being a mirage. Some studies suggest a productivity paradox. Experienced developers, when forced to use AI tools, are sometimes finding that their tasks take 20% longer due to the need to debug and verify the often flawed code generated by the AI. We risk creating a workforce that is dependent on tools they do not understand, generating output that is mediocre at best, while simultaneously freezing out the next generation of junior employees who never get the chance to learn the ropes. The U.S. hiring rate currently sits at 3.2%, the lowest level since the depths of the 2008 financial crisis. Companies are not hiring. They are waiting. They are hoping that an AI agent will be able to do the job of 3 people for the cost of a monthly subscription. Until that fantasy is either realized or debunked, the labor market remains in a state of suspended animation, bleeding tens of thousands of jobs among the reality that the Federal Reserve is only now beginning to acknowledge. Moreover, we must scrutinize the commoditization trap and the brutal economic reality that AI technology itself is facing a lot of diminishing returns. As we dig deeper into the mechanics of this industry, we uncover a fundamental flaw in the business model that sustains these valuations: the rapid commoditization of intelligence. Wall Street has priced these AI companies as if they are software monopolies with 80% to 90% profit margins, similar to the Windows operating system in the 1990s or Google search in the 2010s. The assumption that once the model is built, selling it to the next customer is essentially free. But this assumption is proving to be dangerously incorrect. AI is not traditional software. It is a capital-intensive utility. Every time a user queries a model, it costs real money in electricity and compute power. The marginal cost of delivery is not zero. It is significant. This transforms the economic profile of these tech giants from high-margin software businesses into low-margin utility providers. Yet their stock prices are still trading at high-margin software multiples. Furthermore, the competitive advantage that protects a company's profits is evaporating before our eyes. We are witnessing a ferocious race to the bottom in the price of intelligence. Open source models, such as those released by Meta or developed by independent labs, are rapidly catching up to the capabilities of proprietary models like GPT-4, but they are available for free. Why would a corporation pay millions of dollars annually for a closed-source model when they can run a nearly identical open-source model on their own servers for a fraction of the cost? This pricing pressure is already evident. Companies are slashing API costs to capture market share, destroying their own potential for future profitability. We are creating a scenario where AI provides massive value to the world, just like the internet or electricity. But the companies providing it cannot capture that value in the form of sustainable profits. This situation is exacerbated by the law of diminishing returns in model training. The prevailing dogma has been scaling laws, the idea that if you simply feed more data and more compute into a model, it gets smarter linearly. But recent reports suggest we are hitting a data wall. We have essentially scraped the entire public internet. To make the next generation of models marginally smarter requires exponentially more compute and exponentially more expensive synthetic data. We are entering a phase where companies must spend 10 times the capital to achieve a 10% improvement in performance. In business terms, the return on invested capital ROIC is collapsing. We are spending billions to build smarter models that the average consumer, who just wants to draft an email or summarize a meeting, does not actually need and certainly will not pay extra for. The technology is phenomenal, but the business model is broken. This disconnect between the cost to build the intelligence and the willingness of the market to pay for it is the silent killer of the AI bubble. So, how is the smart money reacting to this constellation of risks? We are witnessing a great rotation of capital, and we must follow the money. They are not waiting for the crash. They are already moving. We are witnessing a great rotation of capital, triggered by the Oracle earnings report, which served as the canary in the coal mine. When Oracle missed earnings and simultaneously announced higher spending, institutional investors saw the writing on the wall. The cost of the AI arms race is going up, and the timeline for profitability is getting longer. In response, they initiated a tactical withdrawal from the high-flying tech growth stocks and moved capital into 3 specific bastions of safety. First, money is flowing into volatility and exchange plays. When uncertainty rises, trading volume spikes. Investors are buying stocks like CBOE, Chicago Board Options Exchange, Nasdaq, and Intercontinental Exchange ICE. These companies are the casinos of the financial world. The house always wins. Whether the market crashes or melts up, the transaction fees flow to the exchanges. They are the ultimate hedge against chaos. Second, we are seeing a flight to defensive parking spots. Investors are dumping stocks trading at 50 times earnings and parking that capital in boring. Reliable giants like Procter & Gamble, Coca-Cola, and Johnson & Johnson. These companies sell toothpaste, soda, and medicine products that people buy regardless of whether chat creates a new poem or not. These stocks offer dividends and stability. It is a classic risk-off maneuver, signaling that investors would rather accept a 3% reliable return than gamble on a 30% potential gain that comes with a 50% downside risk. Third, capital is moving into large financials, the too-big-to-fail banks like Morgan Chase and Goldman Sachs are beneficiaries of this rotation. They offer massive liquidity. When a fund manager needs to sell $1 billion of Nvidia, they cannot easily dump it into a small cap stock. They need a deep pool of liquidity, and the banking giants provide that. Furthermore, these banks are insulated from the specific operational risks of building data centers. They lend the money, they don't dig the foundations. Conversely, the losers in this rotation are clear. The hyperscalers Microsoft, Amazon are being sold as their margins compress. The high-beta hardware stocks Nvidia, AMD, Broadcom are suffering from multiple compression. Investors are simply unwilling to pay a premium for slowing growth, and the narrative software stocks companies like Prolanta and Snowflake that trade almost entirely on stories of future dominance are seeing their valuations slashed as the market demands immediate proof of cash flow. As we bring these insights to a close, we must look at the complete picture that has been painted. Friends, we must look at the picture that has been painted. We have the CEO of IBM telling us the spending won't pay off. We have Oracle borrowing money to pretend it is growing. We have Nvidia facing the mathematical gravity of a $5 trillion valuation. We have a consumer economy held together by the paper wealth of the top 10%, and a labor market that is being hollowed out by the very technology touted as our savior. The market is transitioning from a phase of blind optimism to a phase of show me the money. The Great Rotation is not a temporary blip. It is a structural repricing of risk. The credit markets are tightening, the energy grid is straining, and the patience of Wall Street is running out. If the hyperscalers signal reduction in Capex in 2026, which seems increasingly likely given the investor revolt at meat of the air, we'll come out of this bubble with violence. It will not just be a bad day for tech stocks. It will be a systemic shock to an economy that has forgotten how to grow organically. The $25 trillion AI narrative has been a magnificent story, a tale of human ingenuity and boundless future potential, but in the cold light of financial reality, stories do not pay the bills, cash flows do. And right now, the cash is moving to safety. We would be wise to do the same. If you found this analysis helpful, please consider liking this video and subscribing to the channel so we can continue to explore these critical economic shifts together. Thank you.